that real sort of mental cesspool. We all know that the secret to financial failure is losing. Well, it's a new year, and here on Finance YouTube, that can really only mean one of a couple of different things. Either you're running into a fresh batch of videos called something like How to Invest in 2023, or perhaps you're even running into a fresh batch of videos called something like How to Get Rich in a Recession 2023, or Stock Market Crash 2023. And although those videos in some cases have a lot of really good information, Brandon over on New Money, for example, recently did a video on how to invest in 2023. I personally want to take a slightly different approach to this topic, and it's going to be inspired by Charlie Munger and his idea of inversion. Now, I've actually made a video very similar to this before, right back in August 2020, and it was inspired, like I say, from Charlie Munger. Now, Charlie gave a speech in 1986. He gave the Harvard School commencement speech, and the speech he gave was inspired by Johnny Carson, a former late-night TV host in the United States. And Johnny Carson's speech was really trying to help students understand how to lead a happy life. But that's a very challenging topic to communicate in a short period of time in a commencement speech. So Johnny Carson had the great idea of, instead of doing a speech on how to lead a happy life, he inverted it. He flipped it right round the other way, which is often a very good way to solve problems. And he instead gave a speech on how to guarantee a miserable life. I think that is a fantastic example of inversion and a great way to approach teaching quite a complex topic. Charlie Munger clearly thought the same thing, because he basically took that idea and ran with it. Johnny Carson initially presented 3 points on how to lead a miserable life, and Charlie added another 4 of his own. So in this video, I essentially want to give 5 tips on how to guarantee really miserable investment results this year and for many, many years to come. It's going to be a nice example, hopefully, of inversion and some of the things that you probably want to avoid in reality. So if you do enjoy this video, be sure to subscribe to the channel if you haven't already. But without further ado, let's get straight into, I guess, my top 5 tips on how to minimize your investment results this year. Now, tip number 1, of course, is to try and predict what the market will do. Forget individual business results and the valuation of said businesses. That's really not what we want to do at all if we want to minimize our investment returns. Instead, we want to watch financial media and, of course, listen to all their random predictions on what the stock market will do over time. We want to really focus particularly on the things that are completely unpredictable. Things like, what will interest rates be next year? Where will the overall level of the S&P 500 or the Dow or the NASDAQ be in a few months' time? Sitting around like Warren Buffett or Charlie Munger and analyzing straightforward businesses like McDonald's or Coca-Cola is really, I think, too simple, and we should instead focus on much more complex tasks, like trying to understand what the valuation of 500 businesses might do this year. Now, tied into point number 1, the second thing that can be really beneficial in terms of minimizing your investment results is to trade extremely actively. You know, we often hear Warren Buffett and Charlie Munger talk about this punch card approach to investing, where, you know, if you were given a punch card and it only had 20 holes in it, and every time you make a new investment, you have to punch out one of those holes, you would think long and hard about each individual investment you make. And if we really want to minimize our investment results and, you know, basically burn our portfolio to the ground really quickly, we're probably much better off trading actively, you know, paying high commissions all the time, paying a lot of tax, and reacting very emotionally to market prices and the like, rather than focusing on business fundamentals. Like I said in point number 1, we really want to combine those ideas of trying to predict what the market will do, number 1, and then once we've got a good idea of what we think the market might do, we want to trade as actively as we possibly can. That real sort of mental cesspool of trying to predict the market, trading very actively and being extremely emotional, that's gold. That is exactly what you want to be doing. Now, the third point here for trying to get really bad investment results is perhaps for those that aren't quite as interested in point one and point two of trying to, predict what the market will do and trade actively around that. Not all hope is lost. There are other ways for us to lose money in our stock market investments. And the best way that I can really think of is to try and buy the poorest quality companies you can possibly find, ideally at the highest possible prices. Now, a great business defined by Warren Buffett is, of course, one that earns a high return on capital. So if we're looking for a bad business, we want to focus on those that earn a low return on capital. And if you really want to push this to the limits, ideally hunt out those businesses with a negative return on capital, the ones that are losing money hand over fist and really don't have a lot of prospect for ever making money out into the future. If we can combine that money losing ability with a lot of capital expenditures and increasing levels of debt, particularly as interest rates go up, that is certainly the worst possible business you can find. And that's kind of part one of this particular step of bad business, high price. Now, to complete step 3 of bad business and high price, we need to get the high price component. And there's really 2 ways to approach this. Ideally, you want to find kind of a situation where both of these boxes are ticked. And that is both a high absolute price and a high relative price. So when I say a high absolute price, this might be looking at perhaps the long-term average PE ratio on the market of 15 times and trying to find companies that trade much higher than that absolute multiple. Once we've found maybe a basket of businesses in an industry that tend to have really high relative valuations, why stop there? We might as well pick out the one in the bunch that has the highest relative valuation. So let's take all of our electric vehicle stocks, for example, that all tend to trade on really high multiples of sales and earnings, and let's pick out the one with the highest multiple of sales and earnings. That's pretty likely to push us even more towards those very overvalued companies. Now, my fourth tip here to minimize our investment returns in the stock market this year and in the several years following that is to chase short-term winners, particularly if their stock charts are just going up and to the right on an exponential basis and they look like they might be about to take off to the moon. Those are really the stocks, the hot stocks that we want to chase. If the crowd is funneling towards a particular area of the market, or even better, a particular stock, that is really the place we want to get our money in as quickly as possible. If you hear your taxi or Uber driver, mention a particular stock or a particular stock market kind of sector, that is a great place to hunt out some of these poor investments. And it really ties in well to point number 3 here, because typically if there's a lot of people funneling, money towards a particular investment, often that will mean that investment has a very high price. And we're getting kind of 2 birds with 1 stone when we do that. So chasing those hot stocks and chasing those potential short-term winners is a really good way to go. Now, the final tip here to minimize our investment results is that anytime you find an absolute no-brainer investment, one that's really likely to have very high investment returns moving forward, the equivalent, for example, of someone literally handing you $10 and saying, I will sell this to you for $5. Anytime you see those really no-brainer opportunities, you want to invest the smallest amount of money in that thing that you possibly can in the interest of diversifying widely. Now, in all seriousness, the diversification point here is a little bit of a controversial one. Some people will certainly argue well in favor of diversification, and I think some level of diversification is required. But if you're really interested in actually producing good returns over time, it can make sense very often to bet big when the opportunities arise. That certainly doesn't mean put 50 or 100% of your portfolio into a particular stock or anything like that. But, it's not unusual for the likes of Buffett and Munger to bet 10% of their portfolio, for example, into one or a couple of particular stocks when they are extremely confident about the outcome for that business and they think they're getting an attractive price. I really do like the analogy here of a $10 bill being exchanged in the market for $5, simply because there's some sort of short-term issue with the company, or it's maybe misunderstood by the market or what have you. So if you really do want to guarantee those poor investment results and someone turns up at your house with a huge truck full of those $10 notes, offering all of them to you for $5 a pop, of course, just take one of them, because you want to make sure you diversify in your portfolio as widely as you possibly can. So those are my top 5 tips for 2023 on how to maximize your chances of a really poor investment return. We all know that the secret to financial failure over time is to break Warren Buffett's first rule of investing of don't lose money. And of course, we always want to remember to also break rule number 2 of don't forget rule number 1. So hope you enjoyed the video. If you did, be sure to subscribe to the channel if you haven't already. But that's it from me for this one, and I'll see you in the next video. Cheers.